Ouch. This is really bad. The NASDAQ is now only a few percent off a complete meltdown, which was largely driven by NVDA, which dropped by 10% on Friday or lost $190 billion in market cap. And the losses get even worse when we look at the mega caps or the Mag 7. They've lost $930 billion since that March peak. Another way of looking at this is that Wall Street was already expecting subdued earnings or bad earnings. So yes, this looks bad, as the title of today's video suggests. When we look at NVDA compared to the Mag 7, without NVDA, there's not really much growth. What this means is that investors are getting a little bit concerned. And what I'm really wondering is whether this week we get a dead cat bounce. And if we do, is that just going to lead to a rejection on our head and shoulders, which means we're going to go lower? I think this is really important. So what I want to show you is exactly my key notes for this week. We're likely going to print a weekly lower low. What does that mean? Well, let's go over here to QQQ and let's look here to a weekly chart. So we talked about this bearish engulfing weekly candle before. And what this really means is that the losses are starting to accelerate. But the rule of thumb is that when we close at or near a low of a candle, we usually get follow through. It's a very high probability. So that's really what I'm referring to here. We're likely going to print another weekly lower low. The question is, do we close below it? Now let me show you another pattern here, because if we go to SPX, this is where we have the potential, keyword here being potential, for us to form a bottoming pattern and then an expansion signal. So what we're going to be looking for is going to be a failed breakdown, which means that we actually go lower, but then by the end of the week, we actually close higher, which basically just means that we close the week out green because we're right here at the low of the week. That seems pretty simple. Yes. So we're looking for likely a lower low, but do we close below it? And this is going to be against QQQ, which is currently, I think, going to go into an annual failed breakout, because we only have to drop by basically 2 points and we lose this area. It gets worse as we go lower. So tell me exactly what this means. Stay tuned in today's video, and I'm going to walk you through everything you need to know for this earnings week coming up. We just talked about that $930 billion wipeout. Those are big numbers. Do not ignore it. It's the worst fall in 4 years. Ouch. And we're already in correction. So we see that the Russell is down by 8, the NASDAQ by 6, the S&P by 5, and the Dow Jones by 4.5. Yep, it's getting pretty big. We now have the worst week since October, and Wall Street was already risk addicted as bad news piles up. There might be some more geopolitical tension over the weekend, but we're going to focus on earnings for today. The S&P is heading for a rough patch as buyback blackout arrives. Yep, it's been a pretty bad week. All right, so are dips normal? Yes, they are. We get 7 3% dips a year. We get 3 5% dips, 1 correction. So the question is, how far down are we going to go? The pattern I just showed you means that, hey, if this is the bottom, we know exactly what pattern to look for. This is easy. That's what I like. I like easy stories. I like simple stories. The challenge is that when we looked here to this bearish engulfing candle on the NASDAQ, which is in focus this week, the average declines. I went through and did the math before recording the video. It's 16%. So on average, after this pattern forms, we're down by 16%. So I don't know if we're down by enough. That's why these key areas are so important this week. Do not forget those. All right, so is it going to be a dip? Is it going to be a mild correction or a full-out correction? I think that really matters. Another image here shows us that in election years, we tend to chop into Memorial Day, which means sell in May and go away, but come back during the summer, not back on Labor Day. We go higher. So maybe we're in for a bit more of a rough patch here. Okay, cool. And these yields that just keep going higher and higher means that the $6 trillion in money market funds is not really supporting stocks as of right now. Only 31 billion was taken out. So, man, we need this money to start coming out. Otherwise, the market might keep crashing, which is why we're now down here into fear, right? We were in greed a month ago. Now we're back down into fear. And we're racing down towards extreme fear. So extreme greed to extreme fear, extreme greed to extreme fear. Oh my goodness. And now we're going to go through and explain what happened to these chip stocks. But just before I do that, I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up and subscribing to the channel, I would greatly, greatly appreciate that. Thank you for your support ahead of time. So earlier in the week, we heard from TSMC telling us that they have an outlook. Sorry, they have concerns on global chip outlook. Cool. And then I think it was the next day, SMCI dies as it skips earnings pre-announcement. We talked about this on the video on Friday as well. The AI company did not decide to pre-announce their fiscal results, which they've done in every previous time. It's an odd reason. So there you go. What happened? Man, the stock went down by 23%, lost a quarter of its value, basically. Those are big numbers. And tech stocks were already on track for their biggest weekly rout going back to 2022, or their biggest weekly loss in 17 months. Are these losses going to accelerate? Because NVDA down by 10, man, that's a big slide. We can't ignore it. So let's make sure we understand what this means. Because the Magnificent Seven influence over the S&P has never been greater. They're now basically 1/3 of the S&P. So where tech goes, the S&P goes. And as we look here, we already mentioned that we were already expecting subdued earnings. We got a negative reaction from JP Morgan, even on a beat. Same thing with Netflix. So this week's the big week. We get most of the earnings reported here. And then by next week or April 30th, we will have the bulk of earnings out. This just shows the number of companies reporting. This week and next week really matter. So when it comes down to Tesla on Tuesday, Meta on Wednesday, Microsoft and Alphabet on Thursday, what are we expecting? Well, here's the numbers. I did the homework for you. Maybe you want to consider smashing that thumbs up and subscribing to the channel as a way of saying thank you. I'm just joking. If you want to smash it, great. If you don't, no problem. I appreciate your support anyway. So Tesla is the only one expected to miss. We're expecting a 16% miss here. They got price cuts on the Model Y. They're laying off staff. Man, things look a little bit shaky over there. They laid off 10% of their staff as well. So Tesla is likely going to suck. So the first half of the week, hey, we're likely going to get that lower low like I talked about. But as we now shift gears, sort of look to the second half of the week, notably Meta, Microsoft, Alphabet, and then we also have some key dates. I'll touch on these a little bit later here. We got notably Core PCE coming in on Friday. I'll get to those in a minute here. But anyways, if we're going to go down into the first half of the week, how can we save the chart? Well, we need these companies to deliver, as I talked about on Friday as well. So if this is going to be a bad miss from Tesla, I think guidance is going to really matter. But I don't know, robotaxi or not, I'm not sure it's going to be able to shake off that bad number. These are just whispers, by the way, too, so they're not confirmed. When we look to Meta, though, which reports next, 4.4% beat. I think the outlook's going to really matter for Meta. Looking to Microsoft, here, 3.6% beats, right? They're beats, around 5%, nothing more. But Google also looking for about 4%. So collectively, we have a suck with Tesla, which is estimated or whispered. And then Meta, Microsoft, and Alphabet, hey, they're probably going to come in better. Do we already have enough of a negative reaction with that $930 billion wipeout? Or is there more pain in store? Please drop me a comment and tell me what you think. All right, this also matters because short sellers actually went net long in a major way. The most long they've been, going all the way back to March of 2022. I don't know if I like that. Now shifting gears here to the economic data for this week. We got services PMI coming out on Tuesday. We got GDP coming out on Thursday. And we also have core PCE coming in on Friday. I want to focus on these two data points here because I believe they're fairly important. So as I just mentioned, first half of the week versus second half of the week. We don't just have earnings. We got two really important data points. GDP or growth, and then core PCE. Let's look at those a little bit closer now. So the Fed's preferred inflation gauge is set to back rate cut patience. And I don't really understand the reason why. So Jerome Powell looks like he's got a little bit of a sourpuss here. Why? Well, here's what Bloomberg tells us, right? Fed's preferred inflation gauge seen holding up. Well, we're actually supposed to go down to 2.6, but it's the month over month number, which looks a little bit hot here, right? 0.3. That compounds at roughly 4% per year. So 2.6 is like pretty close to the Fed's target. And the other reason why this is notable is because we're still getting pretty solid growth. This is GDP now, and it shows a 21% quarter over quarter growth. For the official estimate, we're looking for about 2.5%. So I want to see where the number comes in. Inflation at 2.6 and GDP, if it comes in at 2.8, man, that's a soft landing. Growth is higher than inflation. That's good. So will good news be good this week? Hey, we're likely going to find out. And what we're likely going to find out is whether or not this weekly heat map of everything down, except for a few small blocks, is going to change like it did here on the daily chart, daily heat map, where we note that excluding the Magnificent Seven, kind of cutting it off right here, man, everything kind of did good. It was a stealth rally. So as I mentioned, pause the video if you want to see these numbers, but we have numbers coming out here, right? Really important. And then Amazon is supposed to give us a 11% beat on the 30th. Apple's earnings are not yet confirmed with a number. Okay. So now tell me what this means, because you mentioned the word stealth rally. Yes. Well, on Friday, the green team was pretty big. Volatility, equal weight, treasuries, Dow Jones, XLV, XLF, CAF, energy, utilities, New York Stock Exchange, KRE, IET, BTC, ETH, GC, oil, versus the momentum trade, which here has been the Mag 7, QQQ, the Dow Jones, the dollar, the 10-year note, blah, blah, blah. Let's just focus on these Mag 7 stocks, because what this really means is that we want to pay attention to the stocks that report earnings this week. This is the Mag 7, or the Magnificent 7 ETF. What do we note here? Man, volume usually precedes price. That is fat red volume. And we're pushing off the 50 and actually projecting lower. That's not good. This is a precursor for what usually happens to price. As volume increases, as we're going down, we usually go down more. So now let's look at each one of these individually to better understand their setup going into earnings. Here we're looking at Microsoft, the biggest of the pack. It stopped going up. We've lost our uptrend. Look for those green lines to see what we're looking for here. And dominant red volume as we go lower. So we're below the 50, we're below the uptrend, and we're currently pointing down. The question for this one is going to be whether or not the short-term drop will be enough as we go into earnings. Why? Let's look back to the last time they reported. Well, we've basically gone nowhere. I would argue we're going sideways. So the last earnings release is about right here. And look where we are now. We're going to do one of three things, which is the only thing stocks can do. We can go sideways for longer, we can go back up, or we can go down. So we're definitely in equilibrium here. And I look at the warning signs because, hey, they're sticking out to me. As we look at these next ones here, well, Apple already sucks. We got a death cross. And I hate to say it, but this kind of looks like a massive M, where we could be looking for more downside. That's what M means. We're already at a 52-week low. And that red volume was a bit of a warning here. So Apple's looking shaky. We look to the next one here, which is NVDA. Well, look, it got rejected here. It's actually going down, and it's got dominant red volume. So without earnings coming out right away, I think it's likely going to be a sympathy play for the rest of these mega caps. Looking here to Google, actually looking pretty good right here at blue sky territory. This one looks good. Are earnings too high, though? We have a lot of red sellers here, right? Lots of red volume. All right, moving on to Amazon. Looks similar to NVDA. Stop going up. It's below its 50, and volume is dropping off here. So we're finding equilibrium. I think it's really just going to do what the other ones do. But remember, we don't get earnings from Amazon until the 30th, but they do move all together. Amazon's been particularly strong because this is only our first daily candle close below that 50 DMA. Just like NVDA, right? Only getting its first daily candle close below. Remember, when we get to 2 daily candle closes below, we're likely forming a trend, which are those exact same mornings we went through on the daily and weekly for the S&P and for the NASDAQ. We look here to Meta. Yeah, first daily candle close below that 50-day as well. We've also stopped going up. So what's going to happen here? If we go down for a gap fill, that's likely going to be very important. Meta might surprise us because I was noticing they had a really big AI play and a partnership with Google and a few other things. So let's see what guidance says. They also have that VR headset, which is going to compete with Apple. Tesla stinks. It's now got a gap fill, but man, this stock has been so bad. So what I'm watching for is whether or not more bad news on earnings is going to drag the stock lower, or if we can actually start going sideways. A lot of people, even including Dan Ives, which is a massive Tesla bull, is now saying this is a nightmare on Elm Street. It's not looking good. And that's it. Those are the Mag 7. So with today's video now over, I encourage you to watch the video on the left-hand side. If not, maybe you want to subscribe to the channel and come hang out with me at 9:30 and 9:15 tomorrow on Monday. I'll go through more charts, but otherwise, thank you for tuning in, and I'll see you on the next video.